In this next segment, we're going to be giving you some insight into how the Stenger family office model of providing you comprehensive advice from our team of experts works. As they make their way up here, just going to give some quick introductions. Mr. Bond Roth, he's the president and senior financial advisor here at Stenger Family Office, a founding member of the firm. Bond leads the team's client operations as well as directly trades portfolios along with voting proxy ballots on dozens of securities. Prior to Stenger Family Office, Bond was an associate vice president at Morgan Stanley Wealth Management. Prior to that, he held positions at Guggenheim, a $300 billion asset manager in Chicago, and BMO Harris Bank's investment division. He is a graduate of Wheaton College and lives in Wheaton, Illinois, with his wife Rachel and 4 daughters. They're wonderful and very well behaved. Chris Jordan is Chief Financial Officer at Stenger Family Office and Managing Director and Head of Tax at Stenger Tax Advisory. He is a certified public accountant and helps create custom tax strategies for businesses and individuals alongside preparing and filing business, personal, and trust tax returns for clients. He graduated from Augustana College and has his master's in taxation from the University of Cincinnati. Chris and his wife, Allie, and daughter, Theo, live in the Chicago area. And then Audrey's a vice president and financial advisor at Stenger Family Office here. Prior to that, she was a financial advisor at Timothy Financial in Wheaton and worked at UBS Wealth Management. She is a certified financial planner and a graduate of Hillsdale College. She and her husband currently live in Ann Arbor, Michigan. Next, we've got our resident cowboy, as he was introduced last night, Cody Waiscott, who's a vice president of family office services at Stenger Family Office out of our Houston office. Prior to joining, Cody was an estate, gift, and trust tax specialist at RSM. He obtained his JD from the University of Oklahoma College of Law, and he and his wife currently live down in Spring, Texas. And then finally, we've got Brandon Ayers, many of which you know is the owner and lead attorney at Legacy and Life Law Firm, an estate planning law firm based in Naperville, Illinois. Brandon and his team advise clients on estate planning strategies, including wills, trusts, and other advanced protection strategies. He got his BA or his bachelor's from the University of Minnesota, master's from the University of Southern California, and JD from Northern Illinois University. I just need to mention Stenger Family Office does not provide legal advice and is not an attorney itself. All legal advice is provided by third-party licensed attorneys. So just want to quickly reiterate, this is our team of experts that we have put in place to bring you the clarity and the confidence on each individual piece of your plan while also creating one singular cohesive plan. And that's what you're going to hear today. So Bond Roth, take it away, sir.
Thanks, Sam. And your boys are pretty well behaved too. They just got a little bit more energy. Yeah, Bobcats. And thanks everyone for coming today. Really appreciate it coming to this year's Investor Day. For this panel, we're gonna go over a few topics, including financial planning with Audrey, tax and estate planning, of course, with Chris, Cody, and Brandon here. But before we get started, let's get the big elephant, out of the room. There was an election on Tuesday. DC is gonna look a little bit different with the president-elect, the Senate, a little bit of mix-up in the House. So, Chris, I wanted to kick it off with you on the tax side. What big changes do you see coming up with
Yeah.
everything going on?
No, I mean that was the big question during the election cycle, right? The economy, and we're in an interesting situation here because we have a tax bill that was passed by the president-elect 7 years ago, and now he's coming back into office while it's expiring. So, I think that wasn't really the plan when he passed it the first time. I think the goal is to have 2 terms in a row, but now it's his turn to enact a new tax law. So. Like many people know, a lot of those provisions in the TCJA that was passed expire at the end of 2025. So kind of like just to put this out there, like they do need to pass a bill. We have expectations, but they do really need to actually work together, and something does need to get passed next year, or else starting 2026, we go back to the Obama era tax laws, which are much higher. There's a lot of different things that come with that. So but this was probably like the cleanest outcome, I think, to have a tax bill passed next year. Like I mentioned, you have the administration that passed the current laws is now back in office. They haven't called the House race yet, but it looks like the GOP will control that. So you've got one party controlling all three between the Congress and the White House, and they have the Republican Party too has their framework with the TCJA. So a lot of talk has been to just extend and make permanent the laws that we currently have, like the higher standard deduction, a lot of the business provisions in there. But there's been a lot of things too that Trump has talked about on the campaign trail, like not taxing income, like no income tax on Social Security, overtime, tips. They have talked about revisiting that $10,000 state tax cap and the itemized deductions. That's one thing they've talked about. Other provisions like helping out police and firefighters as well. So there's a lot of things that they've talked about, but I think one issue that they're going to face is the debt that the government is facing right now. And a lot of third-party people have looked at the extending the current laws, and that would add trillions and trillions to the national debt over the next few years. So it's going to have to be a mix. If we're going to be adding in even more tax reductions, like no tax on Social Security and tips, something has to give. So it's got to be on the spending side at that point. So that'll be one of the hangups, but it's a pretty clear-ish framework, and I don't expect any major shakeups as we sit here.
Thanks, Chris. And Cody, I mean, on the tax planning side, you want to add any color on that stuff with everything going on?
Yeah, like you said, there was a lot of uncertainty before Tuesday. Thankfully, there's a lot less now. We don't see any big changes coming over this next year or any drastic things you need to be doing differently. However, I would definitely keep maximizing your tax advantaged accounts, deferring the income, tax loss harvesting, and all the other things that these people have set up for you to keep doing.
Yeah, I guess Brandon, kind of going into the estate planning side of things. What are you thinking with the new president-elect and everything going on?
Yeah, well, tax laws for me have always been a multi-generational thing, not an annual thing, right? So the tax play that's since 2017 has been when your kids inherit your IRA, what kind of tax future are they going to be inheriting into? So certainly if they extend or make permanent those reduced taxes, it lowers the likelihood of, the 39, 42, 77, whatever tax rate you want to believe. We might be the highest tax rate under a Democratic administration. But at any point, the pain is still the same because they're still going to have whatever tax rates are. It'll be the highest earning tax rate when you inherit IRAs for this next generation going forward. So that the problem is going to stay the same. It's just a matter of what rate we're going to apply to it and to make it better or worse.
Yeah, for sure. And then on the financial planning siding with Audrey. Oh, you guys share.
Sam stole my mic.
Yeah, stole your mic. Oh, Sam stole the mic.
Sam walked away with the mic. So we'll be sharing.
On the, with the election over, we're getting a lot of people talking about, okay, now that the election's over, should I be switching up my financial plan? Should I be making any big decisions right now? What are we kind of talking about on that side?
Well, first things first, I just want to say I am so glad to not see any more political ads when I'm trying to watch football. So really happy about that. But in terms of the financial plan, kind of like what Brandon said, and I'm going to quote Nick Stanger on this, stay on your plan, stay invested, because it is true. Whoever is seated at the head of our country and the leader of the free world isn't going to change drastically what your plan should be year after year. You don't need to uproot things just because we have a different person at the head of our country. So that's really what it comes down to, is as long as you have had thoughtful planning with your advisor, you're going to be prepared for the next decade, for the next 2 decades. Because again, we go back to the 80s, we've seen many, many different presidencies, and that's what it comes down to, is thoughtful planning on the front end. So you don't need to uproot things when there's a change.
Yeah, for sure. And I think Nick probably took that from his dad. Oh, thanks, Sam. I think Nick took that from his dad. I remember sitting with Ron and he would say, hey, just because, someone different sitting in the Oval Office, don't make any drastic changes, right? So stick to the plan no matter what. That's what the plan is for. But looking ahead over the next couple of decades, we're talking more and more about the great wealth transfer. Some of you are probably seeing that in the newspaper and whatnot. We talked a little bit about it last year. And that's that great wealth transfers, the amount of funds, right? Assets are going to be going down from essentially the boomers to the next generation. So a lot of it going to the Gen X and Gen Y, the millennials. So it used to be reported that about 79 trillion, so that's trillion with a T, is going to be going from the boomers to future generations and a lot to charity as well from now until the year 2045. So there's a lot going on that end. But yeah, Bank of America projected now with, all the excessive government spending, the inflation, everything Nick kind of talked about in his presentation, that number is going from 79 to 129 trillion. That's a really big jump. So Brandon, kind of thinking about the estate planning side, that's a lot to unpack, with the great wealth transfer coming. I thought it'd be great just to start with the basics, trust versus will. What do you think? And then, of course, kind of tie that back into the great wealth transfer.
Well, to answer the direct question directly, trust versus will, what do I think? Trust is the answer. But,
Yep.
I see estate planning documents as like tools. Each tool has a different job. It's like your hammer can help hang up a picture, but isn't going to, shovel your driveway for you. So, a will is the tool that you'd use to override a state's default rules, but it wouldn't avoid probate, wouldn't do much in anything in tax efficiency or anything of that, wouldn't keep things private or is cost efficient on the back end. Whereas a trust does those things. And then you can also customize it to provide, protection or planning when it comes to the great wealth transfer. I know this past year we sat down with the client, we spent significant time with the client talking about how to protect their kids from when they receive inheritance from being incentivized to still work, but also raising the floor on what their worst case scenario was. And getting that kind of stuff done is really important so that they can, start a business and not lose the house, but also have to still work and not just be freeloading off the trust funds.
Kind of with that client, I remember what you were talking about now. It's more of like give them a little bit of a pension basically before retirement, and then all the funds were kind of released after that.
You do that in a trust, it stays private, it's not public knowledge, it's, completely administered according to terms, can change, as time goes on, clients can change their minds, or as new facts come out, new tax laws come out, we can always adjust.
Yeah, and we're also seeing a bunch of folks start giving while living. That's kind of the phrase you might hear on TV or the media or whatever, giving while living. And that's the idea, to start giving to the kids and the grandkids before you're gone, right? You get to see the smile on their face, right? So Cody, I was going to ask you a question about that. We're seeing a lot of that, giving while living with the boomers, especially. Can you kind of explain this phenomenon?
Yeah, absolutely. I think that boomer generation especially is seeing dramatic shifts in the political environment. And currently, you're seeing more and more interest and focus on taxing assets after death. That's not within your control. You don't know what the political environment's going to be 10, 20 years from now. So gifting is a great way to control that narrative, to have control over your money, especially in times of uncertainty. And you pass down a legacy. It doesn't take a large gift to change a life. I was hearing a conversation earlier where $1,700 a month was changing the life of their kid. And you want to leave that legacy to people. You don't want the government involved in your death at all. And using tips like lifetime giving and tools that Brandon can handle you after death are key to that.
I had a client years ago now call that giving with warm hands. And that's always stuck with me. There's value to it, right? You get to see them enjoy it, right? You get to go ahead and make a trust. We have working with Chris on a file, right? We're working on gifting to irrevocable trusts, one for each of the kids, so that they get an estate tax exclusion when they're gone. In the meantime, their kids are going to have this money to start businesses or buy houses or cars or pay for school, all these things at a tax advantaged way. So it can be a huge thing. You think about that compounding effect over multiple generations of lower tax bills, higher floor for risk taking. It can really change the trajectory of an entire family.
And one thing on that too is like working together. We're doing that gifting strategy over a number of years, which really can add up. And then it's not only just managing your tax for the current year, but also looking at what accounts do you have, what are they growing, each year, and what is that going to look like in the future. And I'm kind of looking at the estate tax, trying to minimize that with annual giving, but then coordinating with Brandon is putting it in irrevocable trust. So we're not just giving the kids outright that $18,000 per year that they spend right away. So that trust can add some protection on how that money gets spent.
Yeah, how it gets spent. And then you mentioned a little bit about the type of accounts you like to transfer, basically. So the after-tax portion, especially, avoiding with the Secure 2.0 Act being a big one. Do you mind just sharing a little bit about what that is for folks who might not know what that is, and maybe conversions and things like that? So you and Audrey obviously can tag team that one, but.
Yeah, definitely. Yeah. I mean, we have two Secure Act, and then the 2.0. And that really was in effect for like these retirement accounts. So mainly IRAs. Once you retire, take your 401k, roll it out, and you've got your IRA now. And it's really dealing with those inherited IRAs, which are the worst asset that you can pass on to the next generation. Because not only are they included in your estate,
HSA.
well, yeah, HSA. So that IRA is included in your taxable estates. If you're above, right now that exemption is 13.9 million, and probably will continue under Trump. But you might have an estate tax issue, so it does count as an asset towards that, and it will carry out income tax to the next generation when they withdraw it. Now the other wrinkle is with that Secure Act 2.0, they now have 10 years to take that out. And if you maybe did some wrong planning, if it did go into a trust, that you might be subject to a 5-year payout rule. And we're also dealing with the IRS has been kind of dragging their feet. If there were like RMDs, those required amounts on the account when you pass away, now whoever inherited it also has to take out those annual limits. So there's been a lot of confusion around it, but it's a very short time frame, even though 10 years might seem like a long time. As we run numbers, we're doing this almost on a daily basis for our clients, and those account balances are just keep growing with the market. It means more money that's going to come out of there that's going to be taxed. So looking at ways to minimize those balances while you're still alive is really key. Because a lot of times, kind of last point is that a lot of times those IRAs go to their kids, and usually those children are in their high earning years with their own jobs and their own incomes. And now it's just extra tax that hopefully could be avoided with some planning.
So I would just say right after that, there are so many changes with the Secure 2.0 Act. And so if you do have an inherited IRA and you don't know if you're supposed to be taking RMDs yet, definitely have a conversation with Chris, because we have gone through this so often, and it can be easy to miss things along the way, especially when they're changing rules on you.
We have quite the flow chart if you want to see it.
But if you think about putting it all together, like the worst case scenario is you have like a, let's call it 40% estate tax combined, state and federal. You have a 50% penalty because you didn't take out an RMD. You have the income tax, both on what the RMD was supposed to be and on the penalty, both in the state and the federal level. These taxes add up. And I talked about the positive compounding, when you do planning well, the negative compounding, that is disastrous.
And these assets that are being taxed in these IRAs are not getting taxed at capital gains rates. They are at their ordinary income, which can go up to 39.6 or higher, depending on who the president is at the time.
Yeah, Brandon, you were talking about the estate tax. You don't want to pass away here in Illinois if you're in a certain bracket, would you?
Well, Chris and I I think the worst case scenario is if your kids live in Hawaii and you live in California, I think is the worst combination. But yeah, Illinois estate tax is nasty. Yeah, definitely something you want to avoid.
Illinois is the state to retire in, but not to die in.
Yeah.
So try and keep that in mind.
Do what you want with that information.
You can follow
We
Chris
talked about-
Pass.
Did anybody talk about the folly of trying to time the market? That's a real risk to try and time that one too.
Yes, that's probably harder than timing the market, actually. Probably harder. Audrey, I had a question I want to ask you, because it kind of goes back to the investments a little bit. We got a lot of folks here from, Exxon, Shell, BP in the room, some even from Texas. We're having a lot of those conversations right now regarding 401ks. So I wanted to get to that before we got to some quick hit questions. But regarding the 401ks, we see a lot of folks in these like home office models, very cookie cutter, also called target dates. And I guess we've seen that more and more the last couple of years than ever. What are some examples of this, I guess, and how can people really avoid this trap that's really based on a risk assessment, like a little questionnaire?
Yeah, certainly. So the 401k is often one of the largest investment buckets that you have, because you're faithfully investing every paycheck and you're putting a little bit aside every month, biweekly, however it's set up. And so it can kind of sneak up on you that way. And if you're not working with us on the 401k, I know we will give you advice on it if you have that relationship with us. But if you don't, and you're still stuck in one of the retirement date funds or the target date funds, why it gets tricky is because when you initially sat down and you said, all right, 20 years from now, 30 years from now, I think I'm going to retire and this seems about right. Target date 2040, target date 2025, whatever the date was for you. The way that these are constructed is based on that risk tolerance survey that you would have filled out at the beginning, and it would be based on your age. And an analogy I like to use is like when you're looking for a new home. When you're looking for a new home, do you look at the color of the house? Is that how you determine things? Do you determine it by the size of the yard? When you're going through the home to do that inspection, you're looking at more than just the color of the house or the size of the yard. And that's what we do on our end. We're looking at, are there foundational cracks? Are there things that we should be thinking about? And so what we do is we look at your 401k and we make sure that it's set up in a way that's going to be specific to you and to your needs. That's why we do goals-based planning as opposed to risk-based planning. So a lot of information there, but let me just very quickly unpack that. The reason that the risk route doesn't necessarily pan out is because it's not based on your specific needs. It's based on what you might have filled out in a survey, which can change if the markets are up or if the markets are down. You might have a different perspective. And kind of a quick little example we saw. We had a couple come to us. They were in their early 50s. They were thinking about retirement here in the next 5 or so years. And they'd been in a target date fund all along. And they had never really dug into what they were invested in. And as we ran the numbers back, it was sad on our end to see if we had been able to help them just 3 years earlier, they could have saved $300,000, which makes a huge difference for their plan. And so the reason I bring this up is it can be sneaky because it's very simple to invest in, but it has a huge impact on your picture. And that's why we work with our clients to make sure that they're set up well for success and not stuck in one of these target date funds.
No, thanks, Audrey. And I was just thinking about a second too with the 401ks, Chris, on the pre-tax versus Roth. That's always the big question for a lot of folks who are in that 500, Fortune 500 realm. Do you mind just sharing a little bit of insight between, the pre-tax contributions and the Roth?
Yeah, I mean, it depends, which is probably my answer for every question up here, but it really depends on your plan, right? And it goes beyond just the tax piece of it. It goes to how else you have your assets, what accounts are your other assets in? Do you have the ability, and are you doing those backdoor Roth IRA contributions as well on top of just the 401k at work? So there's kind of a lot that we try and take a look at, and really like my approach with really the tax strategy is trying to just manage your overall life total income tax rate, right? So we know pretty much what rate are you paying right now. We have some estimate of what next year will look like in future tax laws at this point after the election. But then the one thing we don't know obviously is what does 10 years look like? What does 20 years look like? What's that rate going to be? But what we can do is use our expertise, projections out where we think rates are going to go, and look at your accounts. And it really depends on what assets you have, and really how you're funding them. And for a lot of people, it makes the most sense to save on tax now. We kind of use that 32% bracket federally is our kind of number where we need to be doing all pre-tax at that point instead of the Roth. But kind of working up to that point, the Roth is a great option, especially those that are younger, just starting out in their careers. We want to fund that Roth as much as possible, especially knowing if the next 5 to 10 years of their career, they're going to be in the higher earning years. Let's fund the Roth early, hit the pre-tax in the later years, and then do Roth conversions once they retire.
Yeah, so I'll just kind of go off of that for a little bit. So on the financial planning perspective, things that I think about specifically are, does it make sense to pay taxes now as opposed to taxes later? And that's where Chris and I work together, and all the advisors work with Chris and say, based on your rate now, are you going to be at the same rate or a higher rate in the future? And who is going to be the recipient of this money down the line? And things to be thinking about is it going to be a surviving spouse? If that's the case, then in the case where one spouse passes away, then the surviving spouse will then move to single brackets. And so then they end up paying a lot more in taxes than they anticipated. So who is this going to serve? What is this going to? Is it going to a surviving spouse? Are you saving some of the Roth money as a medical emergency bucket so that as you're down the line in retirement, if you have something come up, you're not having a huge tax bill because you already went through something on the medical side? Are you going to have children, grandchildren inherit this money? Well, then, like Chris was saying, when you typically what happens is when you're passing this money along, your children may be in their highest earning income years. And so to be able to give them funds that have already been growing tax free, it doesn't take a hit to them. And of course, we have to have it split out over the next 10 years. There's just so many different things to think about. And that's what we really dive into.
Real quick, just on the surviving spouse piece. When my dad passed away, my mom's tax rate went up 13% when she shifted from married filing jointly to single person. It's a real thing. It can be really hard.
Yeah, one just experience I had was looking at a client's entire plan. We looked at their investments. They had a sizable, IRA. They had a sizable just taxable brokerage account. And their goal on the estate side was to give their children only a certain amount and the rest would go to charity. So we were able to create that plan where we didn't really have a lot of income tax by taking money out of that IRA, because that when they pass, that IRA is just going to go to charity instead of their kids. And so we were able to decide which assets would go to the children in the best tax advantage way. And then that helps adjust our goal of, just minimize the tax for the rest of your life and keep growing that account at the same time to maximize, what's going to charity. And that's what works for their goals.
And just to add to that, if you have a charitable intent and highly appreciated company stock, talk to Chris, talk to me. You need to do that. Don't just cut a check to charity. We can make good things happen.
And what about speaking of charities like donor advised funds? Like
Those
Audrey,
are fantastic.
yeah. Do you want to talk about that, Chris? You want to talk about that, Cody? Any of you?
So there's a lot that you can do with a donor advised fund, and where this makes sense. And I know Chris will talk about this in a second too, but you can do forward giving where you can basically decrease your total tax impact because you have multiple years of giving kind of saved up into this account, and then you can disperse that. So I won't get into the nitty gritty details, but it's a great way to be able to control what you want to give and have a tax benefit as well. It's also fantastic if you have highly appreciated stock, because you're able to gift that into the donor advised fund. And so then you don't end up paying the capital gains tax on that. And you're able to subsequently give to charity as well, and they get the entire amount, and there's no tax impact for them either.
Right. And you're getting that full amount, that deduction on the fair market value of the stock at the time after it's appreciated so highly. So you're really getting massive benefits while avoiding a ton of tax for you, your kids, whatever your plan is.
You can use that deduction to do like a tax-free Roth conversion, for example.
I know we just have a few more minutes here, so just wanted to get some quick hit questions as we wrap up today's panel. Chris, I'll just start with you real quick. As we sit here in November, what are some, last minute ticket items to think about for tax preparation and kind of the planning for next year?
Yeah, I mean, number one this time of year, I always use Thanksgiving as kind of the end of the tax year, because then holidays hit, people get busy. You still have time to take care of some last minute things by the end of the year. But, the biggest thing is by Thanksgiving, if you don't know what next April is going to look like when you file your tax return, you need to be putting a plan together, put a projection, figure out what that looks like, so there's no surprises. So that's kind of the time frame we always use. But looking at, retirement accounts, make sure you didn't overfund that 401k or you did max it out for the year. Same with IRA, if you're planning to make contributions. One thing we see is if people made Roth IRA contributions already for the year and maybe their income was higher than expected, they no longer are allowed to do those Roth IRA contributions. Those need to come out of there as soon as possible. But looking at your charitable giving strategy, normally end of the year is when people like to give a little bit more. So using those donor advised funds, and then also to the estate gifting to individuals, where it's not really saving you income tax this year, but trying to use up that annual exclusion by the end of December.
Yeah, Cody or Brandon, anything on your side before year end?
Well, I would just say on the donor advised fund side, it's kind of donor advised funds from my view as a estate planner have really taken the place of the charitable trust planning, a big chunk of it. And I think that's a good thing. I think there's a certain threshold that you need to meet to get a lot of like the charitable trust planning, where donor advised funds has lowered that, made it more accessible. So to more Main Street type of individuals.
Cody, we're talking a little bit more about corporate trustees more and more. What's a corporate trustee and how can that help some folks?
Yeah, a corporate trustee is great if you have a trust and you may not necessarily have someone who is financially savvy to look over that trust for you while you're here, while you're gone, things like that, because these trusts can last many years after you're gone. And a corporate trustee is going to be a bank or a specific trust company who has a lot of experience doing that, looking over the taxes, the legal things, the ethics, and just administering that with a lot of experience. And it's very efficient. And most of the time, it's actually going to be cheaper and save you a lot of money to get a corporate trustee. Also, they're going to be able to work with advisors here and get you a better return on your investment. So there's more in that trust, and it affects your kids longer, and it provides a lot of benefits.
Yeah, and Audrey, quick question about Social Security. I know there's a couple of you retiring pretty soon, and you're asking more and more about that. When should people start taking social? I know it's like depends on your situation, but
It does depend on your situation. So talk to your advisor. But in general, Social Security, what to know is the earliest you can take it is 62. You do take a hit for taking it early, especially if you have earned income. So do not typically recommend taking Social Security early to then also have earned income at the same time. You typically wait until your full retirement age, which depends on the year that you were born. But for most, it's about age 67 now. And then you can also delay Social Security until age 70, and then you get a guaranteed 8% increase in value per year. Where it comes into the decision making is life expectancy, income. Does it make sense to use your Social Security instead of pulling from your accounts? So those are the things that we look at is what do you need specifically? But just knowing the different time frame, you can take it early, you can take it on time, you can take it later, and there are different impacts.
thank you. Cody, Chris, for you guys, the trend of passive income, right? You see that all over social media and the news. Passive income has a lot to do with rental properties. I know we're talking a lot about LLCs with a couple folks. I guess share when and why you would need an LLC, maybe with a rental.
Yeah, I think anybody who has dealt with rental property knows it is far from passive. So that term is a very big misnomer in that industry. But an LLC can be very helpful for you if you do have expensive income producing assets that possibly could cause some liability down the road for you. And you may not want that liability to come at you. So you put it in an LLC and you can possibly protect yourself from litigation involving a rental property or other big assets that's going to protect you.
Yeah, and I get the question all the time of, what's that tax help going to be from the rental? What can I deduct? How does it really save me on taxes? And in most cases, if you do have like a longer term renter, if it's a few months at a time, year lease, 2-year lease at a time, those passive losses, you got to have, depending on your income, it's pretty low, like 100,000 of income. Those losses just carry over into the future just to be used against future passive income, or upon when you sell the rental property. So you don't ever lose it, but in most cases, it doesn't save you in the current year. Now, what I have a lot of people do is a strategy where, they purchase a rental property. It takes a couple years, 2 to 3 years to start generating true taxable income. So they'll hold one property, and then once that starts to generate income, they buy another one that is operating at losses for a couple years just to kind of offset the tax hit every year. And that's how they build their portfolio over time and save some tax doing it.
And they start making a lot of money on the price appreciation of the house while they're trying to offset that income that's building in the meantime.
And then at the end of it, when you go to sell, you can always do a 1031 exchange, acquire a new property through that process, and defer the taxable gain on that as well.
Perfect. Brandon, what is the most important thing estate plans fail to consider?
Well, I think they really death incapacity though. People, talk about, oh, when I'm done, I want my kids to get this, that, and the other. This is how we really want to structure. And we've talked about it in great detail. But what happens if you have a capacity issue, is there people and you have your trust and your powers of attorney drafted the right way to step into your shoes, help you? Is the back office going to reject the power of attorney because you don't have the right powers listed in it to update beneficiaries on retirement accounts? Just simple little things that one sentence in the document can solve. But if you put the thought into actually getting that sentence in there or not, it's about the easiest miss I see.
And something else that this family office seems to do well that other estate planning entities don't do is talking to advisors, talking to their tax people, talking to their finance people. They create these elaborate estate plans, but don't loop anybody else in. So they are not working together, creating the most tax efficient way to pass down those assets.
I would say it's important, especially as if you know that you want to get your children involved someday, having a conversation with your family of when is the time that I'm going to bring them in just to sit in the meeting with my advisor so that they can be looped in along the way, so that should something happen to you earlier than you expected, or if there are reasons that you become incapacitated to take care of things yourself, it's important to get, whether it's family, whether it's friends, whoever's going to be inheriting that money down the line, it's important to get them involved early on so that they can be in the know. And that's something that we often include.
No, thanks, Audrey. That's great. And then Chris, I know this is a hard one, but what will taxes look like in retirement?
It depends.
Yes.
Here's retirement.
No, we always look at retirement in a couple different phases with the early retirement and then later retirement. And that distinction is the RMD age. So once you have to start taking money out of these taxable IRA accounts, is kind of that distinction between the two time frames. And usually in early retirement, you have more control over your income. You don't have to take anything out of those taxable accounts. So what is it? What do we want to take every year? So the strategy is to take out a little bit every year, use up the brackets, not too high brackets. Right now that's 32% is too high in my opinion. So we don't want to be hitting that, but we can control your income. So doing that every year by either taking money out of those pre-tax IRAs or doing Roth conversions every year to just shift that money over, pay the tax on it now, get it growing in a different account. That's all going to be tax-free as long as you hit a couple, time frame distinctions. And then planning then for later retirement, what is your RMD amount going to be? And what does that look like tax-wise, for the rest of your life?
Yeah, and we get this question a lot because when we built, Stenger Tax Advisory is all based on the advice and not just on the tax preparation. Could you maybe, Chris, Cody, explain a little bit of the difference between just doing the tax prep versus the tax prep and the advice?
Right. And a big question that you should be asking yourself is how often are you meeting with your tax professional? If you are meeting with them once a year, at the end of the year, after the full year, and they're just asking you what you did this year, you have a preparer. And that's great. Somebody's doing your taxes for you, but it's like having TurboTax. They're not providing you any value whatsoever. If you're not meeting with them multiple times a year asking, hey, what are we doing next year? What are we doing in the following years? How is this preparing me for retirement? And that needs to be happening all the time. There is no trigger. There is no event that needs to happen. Just reach out to us, talk to us. That's our job. We're here to help make you happy and to get you to retirement.
Yeah. I mean, the tax preparation business is really a commodity at this point. Technology is improving rapidly to the point where who knows in a few years, but we might have softwares that are automatically preparing tax returns. And to be honest, we use a lot of that internally, where we can use automation to populate numbers in our tax software already. So we're already starting at a base level of reviewing a return instead of all this manual entry that has plagued the industry forever up until now. So it's really taking a step back, looking at the whole picture, because that's something I experienced earlier in my career. I was working just on the tax side, didn't have coordination between advisors, and it just was one part of the plan. So we had instances where, we saved tax that year, but was it the best overall to get money in that account versus somewhere else? That was missing. And really that's how we coordinate and really provide that value.
And coming from a large public accounting firm, I can tell you that not only are they not the partners that you're speaking to every day, your account managers are not looking at your tax return other than the half hour a year when it's done. They aren't giving you value. They aren't contributing anything to your taxes. And most of the time they're having it prepared overseas or by AI. And you may not even know that. So having a in-house advisor that you can talk to anytime that you want about very specific things to you will save you so much money, so much time, so much headache down the road.
I was just going to say real quickly from a financial planning perspective, where this comes into play with taxes is really just being intentional with every dollar, not from a budgeting standpoint, but from a direction standpoint. Is this going to be used for pre-tax dollars? Is this going to be used and put into Roth dollars? Is this going to be going into after tax? Being intentional about where every dollar is housed can make a huge difference over time, year to year, for your estate and for you as the years go by. So just wanted to add that in.
No, that's great, Audrey. And I think that's kind of all the time that we have. So thanks again for everyone coming today to Investor Day. Thank you, Audrey, Chris, Cody, and Brandon. I'm hoping we gave you guys a little bit of insight of, how we all get together, working together under one roof and giving you one cohesive plan.